Canada Goose is a company known for their high performance and very fashionable winter coats. The company, like many others, have been caught in the crosshairs between economic trade wars between China and the United States, and has led to shareholders bleeding out with roughly 1/3 of the company's value dropped. However, UBS recently put out a report claiming that the dip in Canada Goose's stock was overrun and oversold. We'd like to reiterate that standpoint by pointing to two fundamental catalysts of the company to take the talk away from the trade war headache and point to the positives that the business is doing. So first is their growing margins due to their direct-to-consumer business model. The company has two revenue segments, wholesale and the direct-to-consumer. Wholesale is when they sell their stuff to other retailers who then place it in their stores. And direct-to-consumer is either through their e-commerce platform, which came to life in 2015, or through their physical stores, which they have been strategically implementing slowly in key cities all over the world. The company over the years has taken initiatives to sway the business model more towards the direct-to-consumer segment, and this is largely because the huge costs associated with the wholesale model. If you look at their income statement, when splitting the company into their respective revenue segments, wholesale via cost of goods sold accounts for more than 50% as an expense of the company's sales. More specifically, in 2018, cost of goods sold from the wholesale segment was 53.1% of their revenue and 56.7% in 2017. On the flip side, their direct-to-consumer revenue segment was 25.6% in 2018 and 24.5% in 2017. So in other words, for every dollar that they make or for every coat that they sell, the company pays less than half on the direct-to-consumer side versus the wholesale side. Obviously, this makes a big difference in profitability as more of their sales go towards direct-to-consumer, and more of their sales have. In 2016, direct-to-consumer was 11% of their revenue segment, and in 2018, 43%. Now, I know I've said it makes a huge difference on their margins and profitability, but let me show you how vast the discrepancy can be by these two extreme examples. Using their most recent annual report, the company made $591 million in sales. Let's assume for 1 second we create two income statements, one where Canada Goose is 100% wholesale, and one where Canada Goose is 100% direct-to-consumer. The operating income margin becomes 14% on the wholesale side, and 33.7% on the direct-to-consumer side. Furthermore, as we go down the income statement, taking into account interest expenses, income tax, and other comprehensive losses, we see net income margins go from 8% to 23%. Via its most recent data, the company has about 111 million shares outstanding. If we take the profitability from these two business segments, that would lead to earnings per share of 47 cents versus $1.26. The company's 5-year average price-to-earnings ratio was 70. If we multiply that by the earnings per share, we conclude with a stock price difference of $32.90 versus $88.20. If you'd like a more elaborated breakdown of this income statement split, look no further than the article version of this video on seekingalpha.com. The link to that is just below in the description. So a difference in stock price of $32 versus $88 tells us exactly why the company is and should continue to go towards the direct-to-consumer model. And although the company may not be 100% direct-to-consumer yet, it does give us a good idea of the kind of profitability this company can reach and the growth they will experience on their stock price as they continue to leverage more towards that direction. As I said, from 11% to 43% in just 2 years, it's not a crazy idea to see the company go to 60, 70, or even 80%. Which brings us to catalyst number 2, a growing presence in the international markets. Our most recent example takes into account a no-growth model. However, the reality is Canada Goose is growing quite substantially. In fact, in its most recent year, it saw its largest sales growth year, a 46% rise in 2018 and a 38.8% rise in 2017. The company's sales segments geographically are split between Canada, the United States, and the rest of the world. And Canada is their most developed market, where they sell roughly 52 jackets per 1,000 addressable customers. This penetration success rate that they've had in Canada, they've been trying to implement in other corners of the globe. And this makes sense because at the end of the day, Canada Goose is not a recurring revenue business model, meaning once you buy their jacket, you kind of have it and that's it. And Canada has a fairly small population. Here are the split in sales over the years. As you can see, Canada still is the most dominant figure. But if we look at the sales growth trajectory, in the last year, the rest of the world grew 52.6%, the largest of the three. Though it should be noted, all three are growing quite substantially. As I said, 53 per 1,000 Canadians has been their penetration rate in Canada. However, in larger addressable markets such as the United States, Western Europe, Japan, South Korea, and China, their current penetration rates range from 1 to 10 units per 1,000 addressable customers. As they continue to strengthen their brand and build their customer access globally, achieving the 35% penetration rate in Canada would more than triple their annual volume. This article, we like to think, will put into perspective just how strong the growth for this company can be. With the slash in their stock price given their recent fumbles in China, it may create a very attractive and prosperous entry point. And we will be looking very closely at these two figures, international growth and direct-to-consumer segments, in their next earnings report, which will come out on February 8th, 2019. The Elevate Group provides media, content, and research in a number of subjects in life. Feel free to check out our other content. Thank you for listening. Have a nice day.